The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Good morning and welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Juliana Tattlebaum. These are your headlines. Japanese yields jumped to multi-decade highs as the Bank of Japan hikes rates to levels not seen in 30 years, with Governor Ueda saying the central bank expects to continue tightening.
Frozen asset plan on ice after a mammoth 16-hour negotiating session. European leaders agree on a €90 billion joint borrowing plan for Ukraine that stops short of an original goal to use frozen Russian funds.
We all share one clear goal: a just and lasting peace for Ukraine. We gathered with a clear objective to address Ukraine's pressing financing needs for the next 2 years. And I'm very pleased to say we made it.
On the back foot, Nike shares sink in extended trade as disappointing sales in China take the shine off a top and bottom line beat.
Very good morning, everyone. There is a trend, of course, in the UK economy where actually the UK households are saving like they haven't saved in decades. And it also transpires that they're not spending either. The latest UK November retail sales figures look underwhelming for those looking for signs of life from the consumer and the services sector. November retail sales were up 0.6%, but compared with the poll, expecting up 0.9% month on month. They were actually year on year, I beg your pardon. They were negative month on month, negative 0.1% month on month. The expectation was up 0.4%. I don't need to give you any more data on this one, but safe to say this is an underwhelming piece of data and just underlines why the Bank of England cut rates yesterday.
I can piece that together with what you're saying around savings with other central banks. And yesterday, as we heard from Christine Lagarde, the ECB was talking about a lot of consumers replenishing their savings after a series of inflation spikes and, of course, the pandemic era. Getting through that, it's been very, very difficult on the household wallet. So they are saving more to compensate. And I think that's one of the factors for central banks to now contend with. To me, we had a very full suite of central bank decisions this week. I mean, especially yesterday, Bank of England, ECB, Norges, Riksbank, and today as we round out the week, it's Bank of Japan as well as we take stock of where they're at. For me, this is a significant one because of the cheap funding currency implications for the world economy, for global markets. I saw some estimates that it was about 1 trillion that has been used. If you look at the foreign lending numbers, that's conservative out of Japan. The bigger numbers are 14 trillion. So as we round out the week, we talk about consequences, I think, for global markets.
For sure. I think the impact of what happens in Japan with the Bank of England could have significant knock-on effects for global bond markets. The Bank of Japan hiking interest rates by 25 basis points to 0.75%, the highest level in 30 years. Now, this hike is the fourth under Governor Ueda, who is deploying a strategy of rate normalization and was largely priced in, with Japanese yields climbing in recent weeks to highs not seen for over a decade, and in some cases not seen since in over 3 decades. Now, speaking after the decision, Ueda said the BoJ will continue to raise rates if the economy moves in line with its forecast. In terms of where bond yields sit right now in Japan, here's a look for you at the yield curve. There you've got the 10-year trading around 2.016%. You've got a little bit of a tick higher in the 30-year right now, about 9 basis points or so, 3.418% is the level. In terms of dollar yen and where we sit in that currency pair, we are around 156 at the moment. And in terms of equity markets, let's take a look at where Asian equities are trading right now after a decent day yesterday. Stateside, we are seeing gains across the region. The Nikkei 225 up about 1% in Japan, but the gains are widespread across Asia. Let's take the conversation to John Plassard, partner and head of investment strategy at Cité Gestion. John, great to have you with us this morning. When it comes to the Bank of Japan, today's interest rate decision was well expected by the market, pretty well telegraphed. It feels like like what's more important is the direction of travel from here, or should I say the pace of travel from here. And on that front, we did hear a little bit more from the Bank of Japan on the pace of adjustments from here. As for the pace of how we adjust our monetary support, that will depend on economic, price, and financial developments at the time. What's your sense after today's press conference and decision around the pace of further hikes from here?
So, hello, Juliana. So it's not a surprise, as you just said, unanimous decision from the members of the BoJ. It's I think it's a normalization because we see that actually the consensus is expecting 2 hikes next year. So it's moving another direction from the other central banks. I think that the movement, and you were just talking about the currencies before, and I think the yen played a central role in the decision, because you know that when the currency is weakening, of course, it's feeding imported inflation. And interesting to notice that this morning the yen is down again because people expect more from the BoJ. I think the movement and the decision was very important because it restored also some monetary credibility from the BoJ. And interesting to notice that the recent data supported also the decision, because export rebound heavily, also in the direction of the US. If you see the growth expected is expected to recover in 2026. So what I call this morning is not a preemptive cut, but a preemptive hike. And this might be the new word from 2026, because we know that the Fed is a preemptive cut, but that could be a preemptive hike. So it's done like it's kind of healthy for the market, because they're moving before something bad or the inflation goes too high. So I liked it a lot, if I can say that.
John, really interesting take here, because when you look at Japanese bond yields, they're trading around their highest levels in more than 3 decades in some cases. And that is in part because there's concern around debt sustainability in Japan. How concerned do you think investors should be as the BoJ embarks on this hiking cycle?
That's the main point of the day, and I think of next year as well, because this is reinforcing the fact that the BoJ needs to move cautiously to avoid destabilizing the debt dynamics in Japan. So this is why I think they're much more data dependent than the consensus is expecting now. Don't expect 2 hikes. It could be more. If inflation goes higher and if the yen goes lower. So really be cautious there. And this is why I'm calling it a preemptive hike, because I think that the consensus might be wrong, as it's always wrong in the beginning of the year. Same thing with the Fed. And so this is really what we're going to look at in the next quarters.
John, amazing. Love hearing your thoughts. This is nothing like a preemptive hike, John. You know it, I know it. The yen is still near some of the lowest levels in years. The wage round last year, just to remind this year, I beg your pardon, was 5.25%. The unions this time round are going to be looking for 5 to 6%. The underlying inflation rate still has a 3 handle. An interest rate of below 1% is nowhere near getting ahead of the curve, John.
No, totally agree with you. But, as I said before, if you look at the data, the core machinery orders are accelerating. We know that there might be, what the government did in terms of injecting money, more than $135 trillion in an economic stimulus. So I think here that they don't know exactly what's going to happen with the inflation, and of course with the new rules concerning the immigration in Japan. So I think there are too many question marks to put on the table that you will have 2, 3, or even more rate hikes in Japan. This is why I call it a preemptive hike because I think actually it is a bit too confusing with what Juliana said before, the fact that everybody's looking at the Japanese bond yields and the inflation expectation. So I think this is sorry to repeat myself, but I think it's a healthy decision that we had today.
Also a healthy debate, John. I take the point around whether we're behind the curve, whether we're a preemptive strike here on a hike. The dollar-yen rates could be significant as well. We've seen some weakness in the Japanese yen as we talk about imported inflation, whether markets would move in the opposite direction, whether that would do some of the job for the central bank by moving the Japanese yen. When it comes to the commentary, I thought that was fascinating too. A couple of dissenters there talking about whether the central bank's view of inflation would see it converge around that 2% target by the latter half of the 3-year projection. We're already there. We're at the 3% mark in terms of being above 2%. So there is some heat on the inflation side. What do you make of some of the dissenters and just when we could actually see that 2% target hit?
I mean, the big question is to know if it's a transitory inflation. No, it's more than 30 years that they are expecting inflation that they didn't get. And I think that the real rates are still deeply negative. The rate differential, you were talking about the US and the dollar, but the rate differential with the US is still huge. So I really think here that we're not in an overshooting of the inflation. I think that Mr. Ueda is doing a fantastic job, actually. And as I said before, there are so many question marks regarding the relation, the commercial relation with the US. What is going to happen? For example, for the moment, everything's fine, I will say, but there are so many questions in terms of monetary injection, in terms of inflation expectation, and of course, in terms of growth for Japan in 2026, that I'm not sure actually that the inflation will overshoot above the 3.5%. That seems to be something very, very sensitive for the Bank of Japan.
Highest rates today, highest interest rates in 3 decades, and actually highest in my career, I've got to say, John. Stay right there. We're going to talk about some of the rest of the markets as well. In the meantime, let's just take a quick look at what we're seeing elsewhere. The BOE has been a very big week in central banking. In another tight decision, the Bank of England cut rates by 25 basis points, leaving the terminal rate at 3.75%, and what analysts are calling a hawkish cut. Committee members signalled caution given inflation risks remain tilted to the upside, with the bar for further easing likely higher though now into next year. Gilt yields had a mixed and muted response to the cut as the markets look for further clarity on the inflation outlook and the potential impact of Chancellor of the Exchequer Rachel Reeves' budget. The European Central Bank maintained rates at 2% in what President Christine Lagarde called a unanimous decision. She added that the current levels of uncertainty made it impossible to offer reliable forward guidance and maintained that policymakers will follow a meeting-by-meeting approach. However, the ECB upgraded its Eurozone growth forecast as the economy proves more resilient than feared, leading to expectations rates will remain unchanged through 2027, with a hawkish tilt more likely. John, let me come back to you and pick up on the ECB because it was fascinating as I've covered it most of this year. The message was that it was very hard for a lot of the central bankers to start giving any forward guidance, especially some of the so-called doves over at the ECB. But then Isabel Schnabel broke ranks in recent weeks and became very hawkish. Now the market's been talking about the next move being a rate hike here from the ECB. What did you make of just how delicately Christine Lagarde had to walk the line yesterday, effectively talking about no rush to change rates from here?
So if I can be honest with you, Karen, I'm a bit desperate when I listen to the ECB. I think they have still and always the same thinking about they don't have any view about the 6 next months. Let's be clear. And I think that being data dependency as much as they have no view about the 6 next months or even 12 next months. And I think that what Isabel Schnabel said. She didn't, let's be clear, she didn't say that they will hike the rates next year. They said that they will not cut rates. This is what I understood. Of course, it creates confusion, but Christine Lagarde yesterday, she quickly answered expectation by stressing there is no predefinite rates path, no active discussion about tightening, etc. So it's still the same as we had last meeting. And I think if there is or if there will be a policy mistake, it will not come from the Bank of Japan and will not come from the Fed. It will come from the ECB. And I really think at some point, let's be clear, they will be behind the curve because they have no vision. I'm sorry to say that. I know Mrs. Lagarde is a fantastic person, but I think that it's not giving a good message to the market. It's not giving a good message to the companies that want to invest because they don't know where the rates are going.
But John, I can't believe I'm doing this. I'm coming in to defend the ECB. This is the first. Look, 2% rate with a 2.1% inflation rate, it's fine. It's what monetary policy should be. It's dull. That isn't where the problem is for our viewers and for your investors. The problem for our viewers and your investors is the fact that we don't have structural reform. In fact, we have governments dithering across Europe, that they don't provide the right capital incentives to build money here and keep it here as well. Having a bland 2% interest rate at the ECB and a bland 2.1%, actually, I'm really pleased about that. That's something we don't have to worry about. It's all the other stuff that I'm worried about, John.
Yeah, so I have another question for you, Steve. Couldn't we have just a little help from the ECB? I think if we look at growth in Europe and especially in Germany, I think even with this debt break that has been taking some part away, I think we're still struggling in Europe and we're still dependent on the energy prices, on growth in China and in the US. And I think we don't have our own growth. I'm sorry. And I know the only mandate from the ECB is to have 2% inflation. But is that helping growth in Europe? Is that helping the view that we could have? Because Europe is fantastic. But here, in that point, okay, they reached their mandate, if I can say that. But what is next? And this is my question. Why can't they help a bit? Some of the countries that are struggling actually and that are awaiting more than the government are giving them.
It's not the 2% interest rate that's killing Europe, John. We've had 4 consecutive rate cuts as well that began in June 2024, and it didn't move the needle on growth. The problem with growth in Europe isn't a 2% interest rate. It's lower than the United Kingdom. It's lower than the United States as well. The problem with Europe is that we have a structural problem. We don't have a joined-up European Union. We don't have a growth trajectory. We don't have capital markets union. We don't have qualified majority voting. We're actually not acting like a union. That's the problem with Europe. John, you know as well as I do historically, and Karen, you were talking about the lowest interest rates in BoJ in the last 30 years as well. A 2% interest rate, historically, most business partners I know would bite your arm off if they could borrow money at 2%. That ain't the problem, John.
Yeah, agree. But let's remember, Steve, that they cut the rates 4 times because the rates were too high, because they were behind the curve. So they had to normalize their rates. This policy mistake that was done also in the US, raising the rates because they were talking about, transitory inflation. So they were behind the curve at that time. And now they are normalizing their rates. But I totally agree with you that I'm kind of desperate that the word is way too strong when I look at what is done actually in Europe, because I don't see anything else. I don't see any growth. Everybody's happy because growth is going to be 1.2% and not 1% in France. Let's be serious. We have inflation close to 2%. So wages are not going up as fast as we would like them to be. So, what is the future for growth next year? I don't see any, to be honest with you.
John, when it comes to the future of growth, we got some fairly downbeat data for the UK just a few moments ago, some downbeat retail sales data, which is adding to concern that we could be looking at a stagnation scenario here in the UK. Yesterday, we got another cut from the Bank of England, but many characterizing it as a hawkish cut. How are you thinking about the outlook here in the UK?
I mean, we're just before Christmas, so I would like to be very positive. But when I look at the weak economic growth and cooling wages dynamic that are behind the decision of cutting rates, I'm not sure the momentum is good. And you were talking about the fact that people in the UK are more, looking and are, afraid in terms of consuming, not consumption, consuming. And this is so actually these conditions are not something healthy, if I can say that. I think that the monetary policy, if we're talking about the Bank of England, is now a more fine-tuning tool, rather than a market driver. So this is a bit different than the ECB. But actually, of course, the momentum in the UK and in Europe, I was saying before, it's not good. And I think at some point we could have good surprises in the US next year, reinforcing the fact, and this is not the consensus that is betting on that, but reinforcing the fact that even the US dollar could peak higher because the Fed could stop cutting the rates at some point, maybe one next year, and growth could be higher. So the US dollar could pick up again, and that could be a hurdle at some point.
John, I think we're going to be talking a lot more about currency implications and the merits of neutral policy for central banks going into next year. Thank you very much for joining us. John Placer with us, partner and head of investment strategy at Cité Gestion. And more on the key takeaways from Europe's central bank decisions. Head online to cnbc.com.
Right, coming up on the show, the frozen asset plan on ice. European leaders turn to Plan B for a €90 billion loan for Ukraine. Plus, we'll bring you Charlotte's exclusive interview with the CEO of Christie's as the auction house wraps up the year on a high note. And we'll be joined by the chair of Edinburgh Worldwide Investment. Wow, this is exciting again, as the trust looks to fend off yet another push to oust board members by the activist investor Saba. Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone, CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
US inflation edged lower in November, but economists are warning that the report is flawed due to missing data from the recent government shutdown. Consumer prices rose 2.7% in November compared to last year. That is way below analysts' expectations of a 3.1% rise. But it was a similar picture for core inflation, which saw a 2.6% increase, lower than analysts' 3% forecast. Economists are pointing to issues in November's CPI report, with the Bureau of Labour Statistics saying it was unable to retroactively collect some data. Markets shrugged off the report, with yields on short-term US Treasuries briefly falling before backtracking, while Wall Street closed off the session higher. Goldman Sachs chief economist Jan Hatzius told our US colleagues what the latest report would mean for the Fed next year.
We have two more. We don't have a cut in January at the moment, but I think I want to look very closely at the next employment report. If that confirms upward pressure on the unemployment rate, then I think January is a possibility. Right now, I would say they wait until March.
Continuing on the central bank action, our US colleagues will be speaking to the New York Fed President John Williams later today. Don't miss that exclusive conversation at 1:30 p.m. London time.
Let's take a look at the market reaction. Karen mentioned the impact that the U.S. CPI report had on sentiment yesterday. Ultimately, all three of the majors did close higher. The Nasdaq leading the gains. That index rose about 1.4% over the course of the session. From a sector perspective, 6 out of 11 sectors were positive on the day, led by consumer discretionary, which rose 1.8%. Energy was the laggard, pulling back by about 1.4%. In terms of the European trade, yesterday Stoxx 600 advanced about 1%, reflecting broad-based gains across the region. Now this morning we're looking at a little bit of a pullback in the UK, French and German markets. Meantime, more gains for the Italian market.
OK, let's get to a story which I thought we'd put to bed earlier this year, but it's back. Edinburgh Worldwide Investment Trust is calling on shareholders to reject a motion from activist investor Saba Capital. Yeah, we just pulled this one out from about 6 months ago, which would seek to remove, it's the same story, it's amazing, which would seek to remove 6 independent directors and in their place appoint 3 US-based individuals nominated by Saba. It comes after Saba Capital, led by BoJ Weinstein, called for the removal of the board of Edinburgh Worldwide Investment Trust in a bid to reverse what the activist investor sees as unprecedented value destruction. Brilliant that we got Hugh Leask with us as well. He's our reporter covering this as well. Hugh, I think I'm right in saying that this is back to the future. B, Edinburgh can turn around and say, well, actually, the NAV discount that you've been going on about, BoJ, actually, we've sived that aggressively. The NAV discount is a fraction of what it was. And they can also say that actually they've through their buyback as well, they've improved the perspective of the whole company. Haven't they done a lot of what BoJ Weinstein would have done anyway?
Absolutely, yeah. I mean, you've absolutely nailed it there. This is
because I read your copy.
This is the kind of long-running dispute between the two camps. You know, you have Saba Capital on one side. They've talked about unprecedented value destruction. They want to kind of completely overhaul the board. On the other side, Edinburgh, you know, they've described it as a kind of aggressive US hedge fund, and they point to the progress that they've made in terms of, as you said, narrowing the discount. And you know, this is something that Saba Capital is focused on for a long time. You know, I was at the Sohn London event a couple of weeks back, and you know, Weinstein made a presentation talking about a storm brewing in the investment trust space, and he was talking about
a storm brewing in his own performance because his main fund was down about 6.5% this year as of November.
Yeah, no, that's fair enough. But I think he has had some successes within the investment trust in investing, and you know, perhaps some shareholders might be kind of taking a look at, you know, last year, the Saba wasn't so successful, but maybe they're going to take another look and think, you know, maybe I like the cut of this guy.
Okay, let's take this to another leg where I think a lot of people are going to be very excited about this next part, which you drew my attention to before we came in air. So how the hell does SpaceX become such an important part of this? Now, SpaceX is a holding of EWIT, and yet BoJ Weinstein's having a go at the management of EWIT, the managers there, because they've sold some of their stake down. And he's saying, well, you know, there's a new valuation on SpaceX, which is, quite frankly, we don't know really what it's worth, but he's taking Elon Musk's word for it, yeah?
I mean, it was almost inevitable that, you know, tech valuations would come into the mix here.
Private sector tech valuations.
Yeah, it's a key flashpoint, the SpaceX holding. You know, it's now the largest allocation within the Edinburgh portfolio, something like 16% of its total assets. And, you know, given that this chatter that we've heard, you know, recently about the IPO, potentially 1.5 trillion, and, you know, all of that has kind of helped boost these investment trusts, you know, a lot of which do have holdings in, you know, SpaceX. And, you know, we saw the tweet from Weinstein, and, you know, he's talked about kind of livid shareholders and so on and so forth.
It does also boil down to who has the experience when it comes to managing some of the assets. And to the point when it comes to Saba, do they have more experience when it comes to US assets as we talk about SpaceX? Because one of the arguments has been the opposite way, that this hedge fund has no experience in overseeing some of these investment trusts. So it's sort of a balance here as you talk about the assets versus the trust itself.
Yeah, that's absolutely right, Karen. And I think the other thing, of course, is it's still unclear as to what Saba ultimately wants to do, you know, once they've got their directors in place, if they get their directors in place, you know, what do they do with the assets? Do they take the fund and roll it into a kind of fund-of-fund model? I mean, you know, that's still unclear. So essentially shareholders have been asked to vote on, do they stay with the kind of slow and steady progress that Edinburgh has experienced, or do they take somewhat of a leap in the dark and go with Saba? Essentially they've been asked to choose between, reform or revolution.
Right.
Yeah, it's fascinating. It's a great story, and thank you very much indeed for the great copy on the website and for bringing it to our attention. Now, you're coming back in the next hour.
Yeah, I hope so.
Are you enjoying being on telly?
Brilliant.
For such an experienced writer, it's a different experience for you.
Yeah, very much so.
All right, you'll be back in a bit, don't worry. You'll enjoy it
Cheers.
more. You'll enjoy it more as you get on. I remember the first time I came on, I covered.
You still remember that?
Yeah, first time.
Wow.
I do.
Good memory.
I had Cutmore and Hobbs and Johnson. They're all CNBC anchors. And I wrote, it was on Mike Lynch, the party of Mark Lynch, who passed, of course, in that terrible accident on the yacht. And I wrote about 20 pages on ARM, and the hit lasted a minute.
I can't even remember the first hit I did on live television. It could have been on absolutely anything.
It was before most of our viewers were born, I can tell you that much.
Yours
it was black and white.
Mine was a little more recent. I'm a newbie, relative newbie. But nothing like Trial by Fire. No, it was about our very own network. It was about Comcast buying Sky.
Baseball, right?
Yeah. Comcast, who are they? Are we still Comcast?
Yeah, we've got another couple weeks.